in the most tax-efficient way. And now, the lighter side of finance.
Well, today, maybe we'll talk about stock market. I don't know, maybe bonds, the Dow Jones Industrial Average, NASDAQ. I don't know, Zach, is this how we usually do the show?
Not even close, David.
Thank you,
Let's
my
kick
friend.
it up
Well,
a notch.
hello. My name is David.Crossan, and I'm a financial advisor and senior vice president of investments for Wells Fargo Advisors. And I'm the host of, not my show, it's never been my show, it's our show, The Lighter Side of Finance. On our show, what do? I always tell people take a deep breath and relax, and let's focus in on the investment and estate planning strategies of retirees and those nearing retirement. Zach, number 2. You fired up today?
I am. I'm ready for it, man.
You know what? I was thinking about this on the ride in this morning. When you get out of bed, maybe you get your cup of coffee, maybe you listen to some music that you like. Most people don't jump out of bed and say, oh, I want to talk about investments. Let's talk about financial matters.
This is true.
And I understand that. So this is what I like to do. I tell everybody listening, if you can have 1 or 2 solid takeaways a week, we've done our job.
I think so.
Think about it this way. When you were in school trying to figure out a particular subject, the teacher's teaching you something in particular, and then all of a sudden, that one moment, you got it. It made sense. It was clear.
Yep.
Wasn't that
That's
a
it.
little bit of a jolt?
Oh, yeah.
So think of it this way. I know investments, financial matters aren't the most exciting things to talk about at 7:30 in the morning, but if we can provide clarity, any particular subject on investments, estate planning strategies, tax issues, it's tax season. We have an excellent CPA in the house today. But that's what I want to do. I want to give everybody a little bit of a jolt, something that where they can say, you know what? I finally get it. I understand it. Or that additional clarity. That makes sense to me. There's my cup of coffee for everybody. There's the little jolt. That's why I want everybody listening Wednesday mornings at 7:30 a.m. You like that little plug I put in there just in case people didn't know that they were listening at 7:30 a.m. on Wednesday morning? Here it is.
Beach Radio, 1160, 1310.
Wow, Zach, that was pretty good. We didn't even rehearse that. Wow, well done. Well, let me tell you something. I am so excited. What did I say when I moved from Sunday morning at 6:30 a.m. to Wednesday morning, 7:30 a.m., is to provide more energy and to lean on local experts. It's tax season. Perfect time to bring in the rock star. I walk in this morning. He's stretching. He's doing push-ups. He's running up and down the hallway. He's actually standing in the studio. He's fired up. I love the energy. Because sometimes when you think of an accountant, they're busy doing their work. This guy brings the energy. I can call him at 7:30 at night with a tax question. He picks right up. 6:30 in the morning, he picks right up. And I figured, why not kick off this new format with Chris Whalen, CPA. Chris, good morning to you.
Good morning. Thanks for having me.
Oh, my pleasure. It's tax season. I know you're very busy, so thank you so much for coming in this morning to discuss what I think are some very important topics. And we were talking before, now that Donald Trump is in the White House, tax plans they're talking about, tax cuts for corporations, for individuals. If you could this morning talk about how these tax cuts could affect people that are currently working and retirees.
Sure. In my entire career, this is the most significant tax changes that are going to be coming. Everyone really needs to look at their tax planning. Like, for example, the number of rates are going to be changing. We currently have a upper tier rate of 39.6%. Donald Trump will probably be lowering that down to 33%. Some of the other changes are going to be with exemptions and standard deductions, which especially will impact seniors. For example, right now, a couple married filing jointly, their standard deduction is $12,600. Mr. Trump is proposing increasing that to $30,000. Right now, there are something called personal exemptions, which give about a $4,000 per person reduction in taxable income. He's thinking of eliminating those. But even with that, a married couple who will now get that $30,000 standard deduction could fare even better and have a great tax savings.
Now, with retirees out there, what do you think they can anticipate with Donald Trump being in the White House and what is anticipated to happen with tax cuts?
Well, we're definitely going to see tax cuts across the board. Almost every strata of taxpayer will see a reduction in tax, and also probably a reduction in taxable income. I see that as my average senior couple, say, might be under $110,000 of income during the year. So they might be able to see a $1,000 to $2,000 decrease in tax with rough numbers right now.
Well, that's so important. And you know what? Something I have brought up in previous shows, and with all the retirees out there, it doesn't have to be retirees when we go ahead and talk about this next topic with tax, is I want to talk about gift tax. I want to talk about, say, seniors that want to gift to their children or grandchildren, or maybe it's parents that want to gift to their children to help them out, maybe for a car, or maybe their first home purchase. Let's start off with annual exclusion and lifetime exemption. I think that really gets confusing for people. Can you explain the difference between an annual exclusion and how that works, and what is a lifetime exemption, how people can utilize that for gifting?
Sure. The first thing is most taxpayers don't realize that when you gift something to someone, cash, it could be a home, it could be stocks, that there could be a tax on that transfer. Most people don't even realize that. But the government allows you to transfer from you to one person up to $14,000 of value each year without a tax effect. So if you're a married couple with a child, you could give $28,000 of value without a tax impact. If you were to exceed that amount, you might have what's called a gift tax. So it's very important to know, to really watch the amount of gifting you're doing every year for family members. So that's the annual exclusion. But also, there is a way that if you want to give more money than that annual exclusion, the government will allow you to take what's called a unified credit or a lifetime exclusion up to the federal estate tax limit, which is now approximately $5.5 million if someone passes away. So technically, if I wanted to give you $5 million right now, I could avoid a gift tax on that by using up that credit.
I hope you do. My goodness.
Yes.
Glad I came in this morning.
We're getting very close. So, but don't forget that when you pass away, then any amount of that unified credit or lifetime exclusion that you've used during your lifetime, you don't have it when you pass away. So if I had an estate worth $10 million and I gave you 5 of that, then I passed away tomorrow, I don't have anything left to take as an exclusion when I pass away in my estate.
See, that is so important because people always ask me that question. David, I understand I can give currently $14,000 per person, married couple $28,000, but there are opportunities if they wanted to give more to lean on their lifetime exemption. 2 different numbers, 2 different amounts they can give away. $14,000 per year currently on an annual exclusion, but if they wanted to give away more, they could actually dip into their lifetime exemption amount, which, what is it, $5,490,000. And I see that a lot of times where people want to give, maybe a home. And I want to talk about that maybe for people that want to start doing different gifting that's in bigger amounts than the $14,000 a year for the annual exclusion. We spoke before about what if a couple wants to gift a home to their children, and maybe can we talk about it as gradually and as a one-time deal?
Sure. Quite often a home is one of the largest assets that a couple would have, and they would eventually like to transfer it to their children or grandchildren. So using this annual exclusion, which we just went over, this is a very good way to do it during your lifetime to avoid tax today, but also to avoid estate tax. So let me give a very quick example. Let's say that we have a home and its value right now is $280,000 to make it easy. And I have a couple that has one child, and they're able to gift $28,000 per year of value, as I just told you. So what we can do is we can gift away $28,000 of the house value over time tax-free up until the time I get to $280,000 of value. So within a 10-year period, I can gift away the entire home and have it completely outside of my estate. I've avoided both the gift tax and the estate tax within the law.
See, that's very interesting because I think people fear, okay, something happens to me. Do I start the process of considering gifting now? Big fear for a lot of retirees out there. They become sick. They need to qualify, say, for Medicaid. And their concern is, I'm going to lose my home. What steps could I have taken prior? And what we're talking about here is maybe here's a strategy for people that are still working or just getting into retirement to start to consider gifting strategies, not only to help their children, but also maybe to get assets out of their estate to avoid possible estate tax, depending on how much money they actually have in their estate, and also possibly if they need to qualify for Medicaid down the road.
Right, and what's important about this is that with regard to a Medicaid issue, is that we definitely want to move part of that title of the home to your child that you just gifted to. So it immediately is reducing the fair market value of your assets for purposes of Medicaid. So, for example, I could gift that entire $280,000 home in one time if I wanted to. Have an agreement with I get to still live in the home, but I no longer own it. So I could gift it entirely today, and tomorrow I don't have any ownership in it at all for Medicaid purposes.
See, this is really nice because with this show, we're looking to not only have conversations like that, but I also bring in estate planning attorneys that can feed right off of that topic. That is fantastic. Thank you for discussing this. And I really want to get into an area that is so important, not only for people that are currently working, but for people that are, say, retired and have these types of retirement accounts. Let's talk about 401ks and for, say, like teachers, 403bs. You and I had a conversation about that. Let's talk about different things about that, maybe some concerns, different objectives with that money, and different things that you can do with the money that's actually in these retirement accounts.
Well, first and foremost is that most clients don't realize how much they're paying in fees with their 401ks. There are so many different categories of fees and types of fees that really can eat into your growth and even your principal. So first, I urge everyone to really take a look, call your plan administrator, and demand that you get the detail of your fees that you're paying and how it's impacting your account, your retirement account. Then I wanted to go into, we spoke of, David, the in-service distributions. Can we talk about that?
No, please, because one thing you had mentioned to me off the air is just concerns. Now, again, don't get me wrong. When you're working, a 401k or a 403b is a nice opportunity for people to put money away pre-tax to invest dollars for their retirement. But you bring up a good point. What if people want to maybe diversify, or like you said, you're concerned about fees and you want other options? Can you talk about what an in-service distribution is and what it can do for somebody?
Sure. And to back up a moment, one of the problems with a plan you have at your job, a 401k plan, is, number one, you usually don't have a trusted advisor who's on your side that's really looking out for your personal best interest, which is one of the most significant problems with it. Also, you usually have a limited range of investment opportunities or avenues that you'd have. Excuse me. Everyone's seen a prospectus where you might be a Fidelity shop or a Schwab shop where they're giving you mutual funds you can pick. So that's also a negative. So what in-service distributions will allow you to do, and of course you'd have to ask the plan administrator because the plan has to allow it, is that it allows you to take that money and transfer it out of the 401k and put it into the hands of a trusted advisor who not only has your best interest at heart, but also will have a multitude of greater opportunities and avenues for you to invest that money. So I urge all my clients to use in-service distributions as soon as they can and as often as they can.
See, that's interesting because I think a lot of people that are listening, they have their 401k, 403b, and they've been making their contributions and they've been saving this money for retirement, and they don't know their options. Say while they're working, they have the opportunity to take a percentage. And again, great point. Talk to the plan administrator about your options. Some plans may not offer this, But a lot of plans do offer this so that an individual that has a 401k, while they're still working, can actually roll over a portion of that 401k to a traditional IRA, where now they have a lot more options. If you're concerned about fees, which that's actually a great point, is, with 401ks and the different fees that are involved. Many people don't know that. They don't know the breakdown of what exactly they're paying to have the 401k. Now they have an opportunity to roll a portion of that money. Well, and of course, if you retired all of that money over to an IRA where they have a lot more options. It could be more cost efficient for them depending on what they choose. And that's actually a great point, is now they could team up with their advisor. They can actually have somebody look over their assets, where I think the biggest thing that people get worried about is, well, I call into my 401k administrator, or I call into who's handling the investments, and it's an 800 number. It's a different person each time. People like that ability to have that one financial advisor look over their assets. Now here's an opportunity that can be a possibility, and have somebody manage it that's maybe handling your other investments. That's a great point. I'm glad we brought that up today, because I think a lot of people aren't aware of it. So what I guess I would say to everybody out there is, if you have a 401k and you're still working, still making contributions, talk to the plan administrator to see if they do allow for in-service distributions, and have that conversation with your financial advisor. Maybe this is a nice time to provide a diversification of what they can invest in, as well as the ability to have their financial advisor keep an eye on it, being that person would handle the investments from that point forward. Another topic we talked about. We're going through it really well today, Zach. I wish we had an hour.
We got it
I have
all.
this notebook full of stuff, but we're going to try and sneak in as much as we can. We were talking about Social Security, and you had a couple of different points you wanted to bring up today.
Yeah, Social Security is something that's too often ignored. For example, people don't realize that, quote, that your Social Security benefits are based on the amount of earned income you've had over the course of your career. And the Social Security Administration is supposed to take your earnings every year and post it on their database and accumulate that so we can maximize your benefit, your Social Security benefit. But quite often there are gaps in that. So number one, I urge everyone to call the Social Security Administration and make sure that they send you a report. There's a detailed report you can get to make sure that your FICA wages, your earned income, has been recorded on their system every year.
That's great. Okay, now let me slow down the train here. Chris, tell us about yourself. We want to learn about you. You've been kind enough to come in here, give us some great information. We can't end the show there. Tell us about your practice.
I'm Chris Whalen, CPA. I have a full-service tax and accounting practice in the Red Bank area. We service small businesses. We're very family-oriented. We make ourselves available to our clients on a regular basis. And you can the best way to learn about me is to go to my website, www.chriswhalencpa.com. That's CHRISWHALENCPA.com. And you can feel free to call my office anytime at 732-673-0510.
Now, it's tax season. You're a very busy man. Are you taking on new clients?
I definitely am taking on new clients.
Okay, so the best thing to do is have somebody reach out to you. I would say for everybody listening today, go to his website. It's very impressive. Go on there and see exactly what Chris does. Chris is a very humble man here. There's so much that he offers to clients out there. The best thing for everybody listening out there to do is go to his website. And I would say right now, with everything that you're doing, do you find people come to you at the last minute? Do you find yourself like, right now, okay, you have a certain amount of clients that you're dealing with, and then all of a sudden, come April, boom, everybody's calling you, knocking on your door? Or is your practice set up in a way that, you just gradually handle your clients and everybody understands that, hey, we have to do this in a very organized manner, if you will?
Procrastinators are very common. So
sure.
My birthday's actually April
So if I'm
Fool's
knocking
Day.
on your door, Chris, I got to get in to see you.
Well, I tell everyone that if you don't have everything to me by my birthday, which is April 1st, then I probably can't get it done on time and you'll be on extension. So that's one main rule I have.
Oh, okay. So you put it out there.
Yes.
That's why I'm asking,
Yeah.
because I don't want somebody knocking on your door on April 14th saying, I need to get this done. So really what you're telling people, if they want to utilize your services, is March.
Right. And I think the most important thing about my firm is that we are in a fast food-based tax prep service. We take our time. I have CPAs doing all the work in my office. And, we genuinely care more than most firms about your best interest, just as you do, David, with your clients.
Okay. Now, that's great. I really appreciate that. Please give out your phone number one more time.
732-673-0510.
Chris, thank you so much. I want to give everybody my phone number here if I can help anybody with their investment or estate planning strategies. My phone number, and again, I offer a complimentary one-on-one consultation. Phone number to get me is 732-730-2050. Of course, go on my website at www.David.Crossan, that's all together, Crossan, www.davidcrossan.wfadv.com. Is that the music, Zach?
That's it.
That's it for this week.
That's it for this week.
That was a lot of fun. Chris Whalen, CPA, thank you so much. For everybody listening out there, have an amazing week, and let's talk next time. Take care.
The Lighter Side of Finance is a paid program. The views and opinions expressed in this program do not necessarily represent the views and opinions of the staff and management of this radio station or Town Square Media, LLC. The purpose of the program is to provide information only. Any financial transaction can only be recommended by a knowledgeable professional who is familiar with your financial situation. Wells Fargo Advisors, LLC is a registered broker-dealer and a separate non-bank affiliate of Wells Fargo and Company.